Have you ever wondered what truly drives the decisions businesses make, or how they manage to stay profitable in a dynamic market? It all starts with a crystal clear understanding of their expenses. At its core, a business's total cost is the complete sum of all the expenditures it incurs to produce goods or services. This critical figure is primarily formed by two fundamental components: fixed costs and variable costs. Fixed costs are those expenses that do not change regardless of the volume of goods or services produced within a relevant range. Think of the monthly rent for a factory building, the annual insurance premium for equipment, or the salaries of administrative staff. These costs remain constant whether the business produces 1 unit or 1,000 units. Conversely, variable costs fluctuate directly with the level of production. A perfect example is the cost of raw materials needed for each product. If a company makes more products, it uses more raw materials, and this cost increases proportionally. Other variable costs include direct labor wages for production workers or the cost of packaging and shipping each individual item. It is also important to note that some costs are semi-variable, meaning they have both a fixed and a variable element, like a utility bill that includes a base service charge plus a charge for consumption. Disentangling these different cost behaviors is absolutely vital for accurate financial planning and strategic decision-making. Businesses meticulously track and categorize these expenses to gain insights into their operational efficiency and profitability. This detailed cost analysis allows them to determine optimal production levels, set competitive pricing strategies, and conduct essential break-even analysis to understand how many units they need to sell just to cover their costs. By understanding the behavior of fixed and variable costs, managers can forecast expenses more accurately and allocate resources more effectively. An insightful detail often considered in economic analysis is the concept of opportunity cost. While not a directly recorded accounting cost, opportunity cost represents the value of the next best alternative that was not chosen. For example, the opportunity cost of investing in a new machine could be the profits lost from not investing in a different, equally valuable project. Another key concept is sunk costs, which are expenses that have already been incurred and cannot be recovered. Smart business leaders understand that sunk costs should never influence future decisions, as that would be like crying over spilled milk. A business's unique blend of fixed and variable costs, known as its cost structure, can actually provide a significant competitive advantage. For instance, a business with a lower proportion of fixed costs might be more adaptable during economic downturns, as it can scale down production more easily without incurring heavy losses. Mastering the distinction between fixed and variable costs and understanding their individual impacts empowers businesses to craft robust budgets, make savvy pricing decisions, and navigate market fluctuations with greater resilience. This fundamental economic understanding is not just about numbers. It is about building a sustainable and profitable future for any enterprise.